The long-standing dominance of the U.S. dollar in global trade faces an unprecedented challenge as China and Russia have effectively sidelined it in their bilateral transactions. This shift, accelerating amid heightened geopolitical tensions and Western sanctions, underscores a broader movement toward de-dollarization that could reshape international finance. Right now, with bilateral trade between these powers nearing complete independence from the dollar, reaching 90–95% in local currencies like the Yuan and Ruble, the implications extend far beyond their borders. Investors and policymakers must confront the reality that this erodes the dollar's role as the world's reserve currency, potentially leading to increased volatility in exchange rates, higher borrowing costs for the U.S., and a reconfiguration of global supply chains. The urgency lies in the hidden vulnerabilities it exposes in dollar-dependent economies, fostering uncertainty that demands immediate strategic reassessment to mitigate cascading economic risks. In the evolving architecture of global economic relations, the bilateral trade between China and Russia has undergone a profound transformation, with settlements in national currencies now constituting over 99% of transactions, effectively marginalizing the U.S. dollar to an optional role in their interactions. This shift, confirmed through recent disclosures from Russian financial authorities in November 2025, reflects a deliberate adaptation to the constraints imposed by Western sanctions, which have severed Russia's access to dollar-dominated infrastructures such as the SWIFT interbank messaging system since early 2022. As of late December 2025, amid escalating geopolitical frictions and a U.S. administration intensifying tariff threats against de-dollarization initiatives, this development not only underscores the resilience of Sino-Russian economic ties, but also highlights emerging fault lines in the international monetary order. The current bilateral trade volume, approximating $250 billion equivalent, continues to expand despite sectoral fluctuations, driven primarily by Russia's energy exports and China's machinery and consumer goods shipments, all increasingly denominated in yuan and rubles to insulate against external disruptions. This currency pivot enhances operational efficiency by eliminating intermediary conversion fees and hedging against dollar volatility, which has been pronounced this year with the U.S. dollar index declining by over 10% in the first half of 2025 alone, influenced by domestic fiscal concerns and shifting global confidence. For policymakers in dollar-reliant jurisdictions, the immediacy of this trend demands vigilant monitoring, as it erodes the foundational advantages that have sustained U.S. fiscal flexibility for generations. Tracing the origins of this transition reveals a trajectory shaped by both necessity and strategic foresight. Prior to the intensification of sanctions in 2022, a substantial portion of China-Russia trade, encompassing commodities like crude oil, natural gas, and metals, was invoiced in U.S. dollars, leveraging the currency's ubiquity in global energy markets and the liquidity of dollar-based financial instruments. However, the exclusion of major Russian banks from SWIFT and the freezing of approximately $300 billion in Russian foreign reserves prompted an accelerated move toward alternative settlement mechanisms. By mid-2023, the share of national currencies had already surpassed 50%, climbing steadily through bilateral agreements that expanded currency swap lines to 150 billion yuan, facilitating direct exchanges without dollar intermediaries. China's cross-border interbank payment system, CIPS, and Russia's system for transfer of financial messages, SPFS, have been instrumental in this process, integrating to handle cross-border payments with reduced latency and lower costs. As of 2025, this infrastructure supports not only routine trade but also complex financial operations, including bond issuances and investment flows, where Russian entities now hold significant yuan-denominated assets in their reserves. The progression has been marked by key milestones, such as the 2024 Joint Declaration emphasizing monetary cooperation, which laid the groundwork for the current near-total de-dollarization, achieving 95% by early 2025 and surpassing 99% amid tightened Western restrictions on Russian energy exports. This historical arc illustrates how geopolitical imperatives can catalyze financial innovations, transforming bilateral relations into a testing ground for broader multipolar arrangements. Geopolitically, this currency shift embodies a calculated response to the weaponization of the dollar system, where sanctions have aimed to constrain Russia's military expenditures and economic maneuverability. Russia's economy, now heavily militarized with defense outlays approaching 6% of GDP in 2025, has adapted by redirecting trade flows eastward, with China absorbing over 30% of Russian crude exports at discounted rates, often settled in yuan to evade price caps imposed by the G7 coalition. The European Union's ban on seaborne Russian oil imports and the adjustment of the price cap to $47.6 per barrel in July 2025 have further incentivized this pivot, compelling Russia to develop a shadow fleet for shipments and rely on non-Western insurers, thereby deepening ties with Beijing. For China, this arrangement secures energy supplies amid its own import dependencies, while advancing the internationalization of the renminbi, which now features in 28.8% of China's overall cross-border settlements as of June 2025. Yet the partnership is asymmetrical. Russia represents only 4% of China's total trade, whereas China accounts for 26% of Russia's, granting Beijing significant leverage in negotiations over pricing and volumes. Amid the ongoing Ukraine conflict, now entering its fourth year, this alignment bolsters Russia's fiscal resilience, allowing it to sustain budget deficits through alternative financing channels, even as Western measures have reduced oil and gas revenues by an estimated 15% in 2025 due to sanctions alone. The geopolitical calculus extends to shared forums like the Shanghai Cooperation Organization, where discussions on regional financial stability increasingly prioritize non-dollar tools, signaling a subtle reconfiguration of influence away from U.S.-led institutions. Economically, the prioritization of yuan and ruble settlements yields tangible benefits while introducing nuanced adjustments to market behaviors. Transaction costs have been curtailed by up to 20% in some sectors, as direct currency exchanges bypass the fees associated with dollar clearinghouses, and exchange rate risks are mitigated through fixed bilateral rates anchored in long-term contracts. This has been particularly advantageous for Russia, where inflation has hovered around 7% in 2025, exacerbated by ruble depreciation and supply chain bottlenecks, yet stabilized somewhat by yuan inflows that now dominate the Moscow exchange, comprising 54% of trading volumes. China's exports to Russia, despite a 9.6% year-on-year decline in the first half of 2025 due to broader economic slowdowns in Beijing, continue to dominate categories like automobiles and electronics, with market shares reaching 60% and 86% respectively, all invoiced in yuan to foster currency familiarity. The integration fosters supply chain synergies, such as joint ventures in high-tech manufacturing, which circumvent export controls on dual-use technologies imposed by the US and EU. However, this shift also recalibrates global commodity pricing dynamics, as Russian oil trades at premiums in yuan markets, potentially influencing benchmarks like Brent and altering hedging strategies for international traders. The broader economic logic here is one of diversification. By reducing dollar exposure, both nations enhance financial sovereignty, allowing Russia to replenish its national welfare fund, depleted by 59% since sanctions began with yuan and gold holdings, thereby maintaining liquidity buffers against external shocks. Within the BRICS framework, this bilateral model accelerates tentative steps toward wider de-dollarization, though collective advancements remain incremental and fragmented. The July 2025 BRICS summit in Rio de Janeiro highlighted commitments to local currency settlements, with members like Egypt and Brazil confirming increased adoption in intragroup trade, yet no unified payment system has fully materialized, remaining in pilot stages as of mid-2025. Progress is evident in bilateral arrangements, such as India-China yuan trades and South Africa's advocacy for gold-backed alternatives, but coordination challenges persist due to divergent economic priorities and capital controls in key economies like China. The absence of a BRICS currency, despite rhetoric at the summit, underscores the practical hurdles, including currency stability and convertibility issues, which limit the renminbi's appeal beyond regional confines. Nonetheless, the Sino-Russian precedent provides a blueprint, encouraging emerging markets to explore swap lines and digital platforms, as seen in the proposed blockchain-based payment system announced in late 2025, aimed at reducing transaction frictions without displacing the dollar entirely. This integration within BRICS amplifies the momentum, potentially drawing in partner nations and eroding the dollar's network effects over time, as foreign investor holdings in U.S. Treasuries have dipped to 30% by early 2025, reflecting subtle shifts in reserve allocations. The consequences of this de-dollarization extend to the gradual diminution of the dollar's liquidity premium, a cornerstone that has enabled the United States to finance persistent deficits at favorable rates. Historically, the dollar's reserve status, still commanding 58% of global foreign exchange reserves, has conferred borrowing advantages, but its share has declined from 70% 2 decades ago, accelerating to its lowest since 1994 by the end of 2025, amid exchange rate adjustments and diversification trends. As China and Russia divest from dollar assets, opting for yuan-denominated bonds and gold, this reduces aggregate demand for U.S. Treasuries, exerting upward pressure on yields and complicating U.S. debt management, particularly with federal deficits projected to exceed 6% of GDP in the coming fiscal year. In forex markets, volatility has intensified, with the dollar's 11% depreciation in the first half of 2025, amplifying inflationary pass-throughs in import-dependent economies and prompting central banks in Asia and Latin America to reassess reserve compositions. For commodity-dependent nations, the shift poses challenges in trade financing, as non-dollar settlements for oil and metals could fragment liquidity pools, increasing costs for hedging and clearing. Hidden risks in this evolving paradigm merit heightened scrutiny, as the fragmentation of global payment systems could cascade into systemic vulnerabilities. Emerging markets, inspired by the Sino-Russian framework, may accelerate similar shifts, leading to a multipolar currency landscape where interoperability issues arise, potentially elevating transaction premiums and disrupting monetary policy transmission. Russia's economy, despite demonstrating resilience with GDP growth of 3% in 2025, faces stagnation risks from over-reliance on China, where a slowdown in Beijing's imports, down 11.9% year-to-date, could precipitate fiscal shortfalls, given that energy revenues constitute one-third of the federal budget. Sanctions have inflicted a cumulative GDP loss of 12% below potential, fostering a fortress economy oriented toward militarization, with interest rates at 21% constraining private investment. For dollar-reliant economies, the peril lies in reduced treasury demand, which could trigger capital outflows during crises, amplifying bond market turbulence and eroding confidence in established financial hubs. Moreover, the proliferation of alternative systems risks regulatory arbitrage, where sanctioned entities exploit gaps, undermining the efficacy of Western enforcement mechanisms and prolonging geopolitical standoffs. As this situation unfolds in real time, with U.S. policy responses potentially including further tariffs, the imperative for strategic diversification in reserve management and trade partnerships becomes paramount to safeguard against these embedded instabilities. The de-dollarization trajectory, exemplified by the intensifying Sino-Russian economic alignment, is precipitating accelerated shifts in global reserve currency dynamics, challenging the entrenched primacy of the U.S. dollar within central bank portfolios worldwide. As of late December 2025, with bilateral settlements between China and Russia exceeding 99% in yuan and rubles, this development not only diminishes the dollar's transactional utility in a key commodity corridor, but also amplifies pressures on its reserve status, which currently stands at approximately 58% of allocated global foreign exchange reserves according to the International Monetary Fund's latest currency composition of official foreign exchange reserves data. This figure, while still dominant, reflects a persistent downward trend from around 70% 2 decades prior, driven in part by exchange rate adjustments and deliberate diversification strategies among emerging market central banks. The immediacy of this evolution is underscored by real-time market indicators. Russian holdings of yuan-denominated assets have surged, now comprising a substantial portion of its national welfare fund, while reciprocal Chinese investments in ruble instruments bolster the renminbi's cross-border appeal. Geopolitically, this maneuver aligns with concerted efforts to fortify financial architectures against U.S. orchestrated measures, including asset freezes and sanctions that have immobilized over $300 billion in Russian reserves since 2022. The unfolding ramifications extend to heightened forex market turbulence, as alternative currencies like the yuan incrementally encroach on dollar-denominated trade financing, particularly in energy sectors where Russia has redirected oil settlements away from the petrodollar paradigm. For international investors and sovereign wealth managers, the concealed perils lie in a potential self-reinforcing cycle. Waning demand for dollar assets could impair U.S. fiscal maneuverability, intensifying debt servicing pressures and fostering inflationary spillovers that destabilize global portfolios. Delving into the historical underpinnings of this shift reveals a gradual but inexorable erosion of dollar hegemony. Rooted in post-Bretton Woods arrangements that positioned the U.S. currency as the linchpin of international finance. In the early 2000s, the dollar's reserve share hovered near 70%, buoyed by its liquidity, stability, and the depth of U.S. capital markets, which facilitated seamless global trade and investment flows. However, the 2008 financial crisis exposed vulnerabilities, prompting initial diversification moves by central banks in Asia and the Middle East toward euros and gold. The acceleration post-2022 stems directly from the Ukraine conflict's economic fallout, where Western sanctions compelled Russia to pivot eastward, elevating the yuan's role in bilateral exchanges from under 20% pre-2022 to the current near-total dominance. China's renminbi internationalization agenda, formalized through initiatives like the Belt and Road since 2013, has provided the infrastructural backbone, with cross-border RMB payments reaching 35 trillion yuan in the first half of 2025, a 14% year-on-year increase. This progression is evidenced by the People's Bank of China's bilateral swap agreements with over 40 foreign monetary authorities, 31 of which remain active as of February 2025, facilitating yuan liquidity provision during stress periods. Concurrently, Russia's divestment from dollar assets, its U.S. Treasury holdings plummeting to negligible levels by March 2025, has been mirrored by China's gradual reduction, with holdings dipping to around $1.4 trillion by mid-2025, the lowest since 2008. These moves, while incremental, compound to undermine the dollar's network effects, where its ubiquity in reserves historically reinforced its transactional dominance. Geopolitically, the Sino-Russian de-dollarization serves as a bulwark against the instrumentalization of the dollar in U.S. foreign policy, insulating both economies from extraterritorial sanctions and enhancing strategic autonomy. Russia's exclusion from SWIFT in 2022 necessitated alternative payment rails, leading to the integration of China's cross-border interbank payment system with Russia's domestic networks, now handling over 99% of mutual settlements. This alignment extends to broader multilateral forums like BRICS, where the October 2025 launch of a gold-anchored settlement unit pilot among the expanded 10-member bloc represents a tentative step toward diversified payment mechanisms, though full implementation remains constrained by internal divergences. For instance, while Russia advocates aggressive de-dollarization evident in its 90% non-dollar trade with BRICS partners by late 2024, China's approach is more measured, prioritizing yuan stability amid its own capital controls. The July 2025 Rio de Janeiro summit yielded no unified currency but advanced blockchain-based systems for intra-BRICS transactions, signaling incremental progress that could erode dollar centrality in emerging market trade corridors. Meanwhile, U.S. policy responses, including threats of secondary sanctions on entities engaging in non-dollar settlements, have inadvertently accelerated this trend, pushing neutral actors toward yuan-denominated alternatives to mitigate compliance risks. This geopolitical reconfiguration heightens the stakes for dollar-dependent allies, as asset freezes, such as those applied to Russian reserves, erode confidence in the dollar's reliability as a store of value. Economically, the mechanics of this shift manifest in altered market behaviors that prioritize efficiency and risk mitigation over dollar intermediation. By bypassing the dollar, Sino-Russian trade reduces conversion costs by up to 20% and shields against exchange rate fluctuations, particularly salient given the dollar's 11% depreciation in the first half of 2025, which amplified volatility in global forex markets. Russian entities have amassed yuan holdings equivalent to billions in reserves, while China's surging yuan lending, poised to surpass overseas dollar loans at its banks, underscores the currency's emerging role as a funding vehicle. Globally, the yuan's share in international payments climbed to 28.8% of China's cross-border flows by June 2025, reflecting its traction in commodity invoicing, including Russian oil exports now predominantly settled in non-dollar terms. This pivot disrupts traditional trade financing, where dollar liquidity has historically underpinned commodity markets. As alternatives proliferate, hedging costs rise and liquidity fragments across currency silos. Central banks observing this have diversified reserves. BRICS nations accumulated $2.1 billion in gold in 2025 alone, bolstering non-dollar buffers amid a multi-year decline in dollar allocations to 56.9% in Q3 2025. Such dynamics foster a multipolar reserve landscape, where the euro and yen maintain stable shares, but emerging currencies like the yuan gain incremental ground through targeted bilateral arrangements. The broader implications for global reserve dynamics are profound, as this de-dollarization catalyzes a reevaluation of portfolio compositions among sovereign investors. The dollar's reserve dominance, at 89.2% of forex transactions despite recent pullbacks, faces structural headwinds from diversification trends, with central banks in the global south increasingly favoring yuan assets for yield and stability. In 2025, foreign holdings of U.S. Treasuries dipped slightly to $9.24 trillion by October, driven by sales from China, Brazil, and India totaling $183.2 billion over the year. This divestment, while modest in aggregate, signals eroding demand that could elevate U.S. borrowing costs, particularly as federal deficits persist at $1.8 trillion for fiscal year 2025, equating to 5.9% of GDP. The interplay heightens forex volatility, with the dollar's co-movement shifting negatively since April 2025, amplifying strains during uncertainty periods where non-US entities ramp up dollar purchases by 24%. Commodity markets, especially oil, face disruptions as non-dollar settlements, now standard in Russo-Chinese energy deals, challenge petrodollar recycling, potentially inflating transaction premiums and altering pricing benchmarks. Consequences ripple through international financial stability, where diminished dollar demand exacerbates U.S. debt burdens, now surpassing $37 trillion and approaching 156% of GDP by decade's end, per Congressional Budget Office projections. This fiscal strain, compounded by interest payments consuming a growing share of revenues, limits policy flexibility, prompting inflationary measures that could unsettle global investors holding dollar-denominated assets. In forex arenas, the dollar's 10% decline in 2025 has intensified hedging demands, with futures and options volumes surging as market participants navigate heightened turbulence. For commodity financing, the pivot to yuan settlements in key trades risks fragmenting liquidity, elevating costs for importers reliant on dollar credit lines and fostering inefficiencies in global supply chains. Hidden risks embedded within this paradigm shift warrant acute vigilance, as a feedback loop emerges wherein reduced reserve demand weakens the dollar's safe haven allure, triggering capital outflows during crises and amplifying bond market dislocations. Emerging markets emulating Sino-Russian models could accelerate this, leading to interoperable but fragmented payment systems that complicate monetary coordination and heighten systemic vulnerabilities. Russia's economic asymmetries, its trade surplus with China masking vulnerabilities to Beijing's slowdown, introduce contagion potentials, where yuan depreciation could cascade into ruble instability, affecting BRICS-wide initiatives. For the U.S., persistent deficits at 6% of GDP erode fiscal headroom, with debt servicing projected to rival defense spending, constraining responses to external shocks. Internationally, the proliferation of gold-backed alternatives, like the BRICS unit pilot, could dilute dollar liquidity pools, prompting sudden reserve reallocations that destabilize exchange rates and undermine confidence in established clearing mechanisms. As this unfolds amid U.S.-China trade frictions and BRICS expansion, the imperative for diversified reserve strategies becomes critical to navigate the intensifying multipolarity in global finance. The emulation of the Sino-Russian de-dollarization model by emerging markets is gaining momentum in late December 2025, as nations within the BRICS alliance and beyond increasingly adopt strategies to decouple from U.S. dollar intermediaries. thereby amplifying systemic risks across the global financial architecture. This trend, propelled by the demonstrable success of China and Russia's near-total shift to Yuan and Ruble settlements, now exceeding 99% of their bilateral trade, offers a replicable framework for countries confronting U.S. sanctions or pursuing reserve diversification amid escalating trade frictions. As of this assessment, the BRICS bloc, expanded to 10 members including recent additions like Egypt and Ethiopia, has not materialized a unified currency, but incremental advancements in local currency swaps and digital settlement platforms underscore a deliberate pivot toward multipolarity. The economic rationale is compelling. By prioritizing national currencies, these markets mitigate exposure to dollar volatility, which has seen the U.S. dollar index decline by over 11% in the first half of 2025 alone, influenced by U.S. fiscal deficits and shifting investor sentiment. This unfolding dynamic heightens vulnerabilities in dollar-centric systems, where reduced demand for U.S. Treasuries could elevate borrowing costs for the United States, currently grappling with federal debt surpassing $37 trillion, or approximately 156% of GDP. For emerging economies, the allure lies in enhanced financial sovereignty, yet the broader implications threaten to fragment liquidity pools, complicating cross-border transactions and eroding the efficiency of established monetary coordination mechanisms. Historically, the dominance of the U.S. dollar in global reserves, peaking at around 70% 2 decades ago, has been underpinned by its liquidity, stability, and the depth of U.S. financial markets, facilitating seamless international trade and investment. However, the post-2022 sanctions regime against Russia catalyzed a reevaluation among emerging markets, exposing the risks of dollar weaponization through asset freezes and swift exclusions. By mid-2023, BRICS discussions had already emphasized local currency settlements, but the trajectory accelerated in 2025, with the July Rio de Janeiro summit yielding commitments to alternative payment infrastructures without a binding unified currency. This year's developments, including the October 31 launch of a pilot gold-anchored settlement unit, comprising 40% physical gold and 60% member currencies, represent a tangible step toward non-dollar alternatives, piloted within the bloc to test viability for intra-BRICS trade. Such initiatives draw from the Sino-Russian precedent, where bilateral trade volumes reached approximately $250 billion equivalent in 2025, insulated from Western restrictions through integrated systems like China's CIPS and Russia's SBFS. Emerging markets observing this resilience are adapting similar mechanisms to navigate U.S. tariffs and sanctions, fostering a gradual erosion of dollar centrality that, while not abrupt, introduces structural shifts in reserve allocations. The International Monetary Fund's third quarter 2025 data confirms this. The dollar's share of global reserves has stabilized at 56.92% after adjustments for exchange rate effects, marking the lowest since 1994 and reflecting diversification into assets like gold and yuan. Geopolitically, the impetus for emulation stems from shared apprehensions over U.S.-led financial pressures, including secondary sanctions and tariff escalations under the current administration. Nations like Brazil and India, facing their own trade imbalances and sanction risks, have initiated yuan-based settlements with China, mirroring the Russian model to reduce dependency on dollar clearing. In May 2025, Brazil's central bank signed a renewed currency swap agreement with the People's Bank of China valued at 157 billion reais, facilitating local currency transactions that now account for about 40% of Brazil-China trade, up significantly from prior years. This arrangement not only lowers transaction costs, but also aligns with Brazil's broader BRICS advocacy for de-dollarization, as evidenced by its hosting of the July summit where discussions on gold-backed tools gained traction. Similarly, India has expanded yuan settlements for oil imports from Russia, with cross-border yuan flows in China reaching 13 trillion yuan in the first 3 quarters of 2025, an 11% increase year-on-year. These adaptations reflect a pattern of market-driven responses to geopolitical frictions, such as U.S. threats of 100% tariffs on BRICS members pursuing non-dollar systems, which have paradoxically accelerated bilateral arrangements. Within the expanded BRICS framework, Countries like Indonesia have contributed $1 billion to the new development bank in 2025, supporting projects in clean energy and infrastructure financed in non-dollar terms, further entrenching the model. This geopolitical realignment enhances collective bargaining power but introduces asymmetries, as China's Yuan internationalization, now comprising 28.8% of its cross-border settlements, positions Beijing as a pivotal actor, potentially influencing terms in favor of its economic priorities. Economically, the logic underpinning this emulation is rooted in cost efficiencies and risk mitigation, as local currency swaps eliminate intermediary fees and shield against dollar fluctuations. For instance, emerging markets under sanction pressures, such as Iran or Venezuela as BRICS partners, are exploring similar frameworks to access Chinese markets without dollar exposure, drawing on Russia's success in redirecting energy exports. The BRICS New Development Bank has disbursed $39 billion across 120 projects by late 2025, increasingly in member currencies to promote sustainable infrastructure and reduce reliance on dollar-denominated debt. Market behavior in 2025 illustrates this shift. Central banks in the Global South have accumulated $2.1 billion in gold reserves, bolstering alternatives amid a dollar share decline to 56.9% in Q3. However, the consequences are profound, as a multipolar currency system fragments global liquidity, elevating cross-border transaction costs by up to 20% in siloed networks and complicating monetary policy synchronization among major economies. The absence of a unified BRICS currency, despite proposals for blockchain-based tokens, highlights practical hurdles like currency convertibility and stability, yet incremental pilots like the gold-backed unit, launched in October 2025, persist, aiming to anchor settlements in physical assets to counter volatility. This diversification, while rational for individual nations, dilutes the dollar's network effects, where its dominance in 89% of forex transactions has historically ensured low-cost global financing. The systemic risks amplified by this emulation extend to heightened forex volatility and disrupted trade financing, particularly in commodity sectors. As more emerging markets adopt non-dollar settlements, evident in China's 12.4 trillion yuan in local currency trade payments last year, global payment systems risk bifurcation, where interoperability challenges arise between Western and BRICS-led infrastructures. This fragmentation could increase hedging premiums and impair efficient capital allocation, especially for dollar-reliant importers facing elevated costs in a multipolar landscape. In 2025, the dollar's weakness, driven by U.S. fiscal concerns and capital outflows totaling billions from foreign holders like China and Brazil, has already prompted upward pressure on U.S. Treasury yields, complicating debt management amid deficits at 5.9% of GDP. BRICS efforts, including the unit pilot, introduce additional layers of complexity, as gold-backed alternatives, controlling nearly 50% of global gold production among members, could redirect investment flows away from dollar assets, exacerbating liquidity strains during market stress. Hidden risks embedded in this paradigm warrant immediate strategic reassessment, as the potential for sudden capital flight from dollar assets looms amid crises. In 2025, U.S. capital outflows have been notable, with investors shifting to foreign equities, currencies, and gold, reflecting diminished confidence in dollar stability post-tariff announcements in April. This feedback loop, where reduced reserve demand weakens U.S. fiscal flexibility, could trigger bond market destabilization, with foreign holdings of U.S. Treasuries dipping to $9.24 trillion by October, down $183 billion from sales by BRICS nations. Contagion effects are particularly alarming. A rapid pivot by commodity exporters to non-dollar benchmarks, as seen in Russian oil trades, risks inflating global inflationary pass-throughs and eroding trust in institutions like the IMF, where dollar dominance underpins lending frameworks. Emerging markets emulating the model face their own perils, including over-reliance on the yuan, which remains constrained by China's capital controls and could cascade vulnerabilities during Beijing's economic slowdowns. As BRICS transitions presidency to India in January 2026, the persistence of these trends, absent coordinated global responses, threatens to undermine the stability of established financial hubs, prompting inflationary countermeasures that unsettle international portfolios and heighten the urgency for diversified reserve strategies among sovereign entities. The gradual nature of de-dollarization mitigates immediate collapse, yet the accumulating momentum in 2025 signals a reconfiguration that demands vigilant monitoring to avert broader systemic disruptions.